It is Friday, June 19th, 2026, and this is the Juneteenth holiday. So I am here streaming live, talking about markets, and the markets are closed now for the day. The futures were open this morning. We had an overnight and morning session, and as you can see here, during that session, the S&Ps were down by 14 and a half handles. The NASDAQ was down a little bit more on percentage terms by 72, almost 73 handles. The Russell 2000 was down by a small amount. It was down by just 4 handles, and the Dow was down by 120 handles, by 0.23%. That's not that much. And so the futures will open overnight and this morning, and now they're closed for the afternoon session. However, stocks, they didn't trade today. Today is also a bank holiday. But anyways, I am here talking about the markets because I got nothing else better to do. There's not much on TV. Like during a regular weekday, there was hardly anything on TV. There were only like 2 shows. Like 2 shows that I actually enjoy watching. On today. So the Fresh Prince of Bel-Air was on this morning, and Friends, who I like the show, but I'm getting so bored of it at this point. I've seen every episode a gazillion times. That was on this afternoon. So I don't know how people do it. They can just watch TV every day, day after day during the weekday, and not be doing something, productive or engaged or something. I don't know. But if people just sit and like watch TV every day and watch regular TV like the Fresh Prince of Bel-Air, Friends every day, I don't know how they do it. Because on my TV, I just flip back and forth and have Bloomberg or CNBC on. They're on mute, but they're on. And then when there's like a sporting event or something major happening, I very often would turn that on instead. Like the U.S. Open is going to be on today, but it's still it's early in the afternoon. It's not on yet, and the World Cup is on today, but I'm not a big football/soccer person. Anyways, so I just said, what the heck? Let's stream. My intention, I have 2 main things that I want to do during this stream. The first thing I want to talk about is Kevin Warsh. I'm very pleased to see how everybody on the internet and on CNBC and Bloomberg is like, oh my God, he's changed everything. This is completely crazy. We have this guy that's going to have all these task force, and he's not going to produce forward guidance. Oh my God, it's like Greenspan again. I'm like, yeah, I know. That's why he was elected as Fed chair, people. Put it together. Gosh, there's so many stupid people out there on Wall Street. I swear to God. Okay? You've had 20 years of this regime. Okay? Where the market is essentially dysfunctional to a certain extent. We're going to go into that in a little bit. And now, you're going back to what was before the Greenspan days. And that's why I go back to what I was saying before on other videos that I've made. Is that when Kevin Warsh was elected Fed chair, I said, I don't think the media, Wall Street, people, the world in general, is making a big deal about this. They're not, I said they're not making a big deal like, they're not making this a big deal like it should be. And my general thesis behind that was that, for the past essentially 20 years, okay, you've had 3 Fed chairs that have been a certain regime, a certain thinking, a certain way, a way in how they communicate with the public, a way of how they approach and think about interest rates and monetary policy, and a way in which they influence markets and have an impact on markets. And those regime changes that came about after Ben Bernanke was after Ben Bernanke started the Fed chair, after Alan Greenspan left, those regime changes that he made, partly because of what he believed in, and partly because of the aftermath of the great financial crisis, have been going on ever since then. And I say that this regime has been going on for essentially 20 years, because 2006 was when Ben Bernanke became Fed chair. But I did some research, and the changes that he implemented really didn't begin right away when he became Fed chair. They were implemented starting in November 2007, and that is when the first change really took place, when the Federal Reserve started releasing the SEP, the Summary of Economic Projections. And it really started the path to forward guidance. Okay, that started in November 2007, which was before the great financial crisis. But then many other changes were instituted after the end of 2008, when the great financial crisis was at its pinnacle moments, during September, October, November, December of 2008. That's when they started doing press conferences, doing the dot plot, issuing concrete forward guidance, and doing speeches where they would get paid hundreds of thousands of dollars to tell the audience what they think about the economy, Fed policy, and they would then go off on what they think should be done with monetary policy. And when you get all these different Fed governors and Fed members discussing that, and all their different views on things, it gets very, very confusing for the markets, which we'll go into a little later. Okay, so what I'm saying is that during that period from November 2007 into around 2012, all these policies were instituted that were basically regime change, where the way the markets reacted to the Federal Reserve completely changed from the Greenspan era. So this is all very difficult to explain. This is not an easy topic. Okay, I could never post these videos on TikTok because they're just too complex. So basically, in the pre-Bernanke era, when Paul Volcker, Alan Greenspan, the Fed chairs, specifically Alan Greenspan, he would be very opaque. He wouldn't, in the Greenspan Fed, not just Alan Greenspan, but the Greenspan Fed, they wouldn't give any forward guidance. They wouldn't give any clear ideas of what they were thinking about the economy, what they were thinking Fed policy should be. They weren't giving clear projections. They didn't have anything like the dot plot to tell the markets what they were forecasting, what they were going to do in the future, going out 1 year, 2 years, 3 years in the future. Greenspan himself, as a Fed chair, believed that the Fed should kind of stay out of middling with the economic system and the markets. And Greenspan believed that the Fed needs to stay out of the way and just be reactive to what things happen in the world. And that includes in the economy, geopolitically, and in markets in general. So stay out of the way and react. Be reactionary to what happens. But don't try to get involved and do things to try to, create the economy the way you see it and so forth. He believed that you shouldn't do that stuff because the markets are smarter than you are, smarter than he is, smarter than any of us are. Okay? And I think that included for him giving your opinion, giving your ideas, your projections, your forecast on what the economy is going to do, markets are going to do, interest rates are going to do and should do. He even thought that any of that should be not involved and just let the markets do their thing. And he believed that as the world turns, keeps going around the sun over and over and over again, stuff happens. And when stuff happens, if the Fed is out of the way, okay, and doesn't middle with things, unless they absolutely have to, in a reactionary function to something that happens, if the Fed is out of the way for the most part, and something happens, whether it's involved with the markets, the economy, geopolitical stuff, war, pandemic, famine, whatever, the markets will react to whatever happens in the world. And Greenspan believed that in a free market economy with markets that are not middled with, they will give the key signals to policymakers, to central bankers, of what they should do. And as a central banker, if you don't middle, you don't get involved giving your opinion, your forecast, your projection, your blah, 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 and don't speak every other day, which it seems like that's what Fed officials and governors did for the past 5, 6, 7, 8 years. Whew. Then the market will tell you essentially what you should do as a central banker. And a perfect example of this is I wasn't trading during these times, so it's hard to come up with a concrete good example. But the classic example, I think, just by studying market history, is during the mid 1990s, 1994, 1995, and a lot of people were saying the Fed should hike rates because the economy was, heating up, and inflation was an issue. Could have been an issue. That was kind of the fear, that the economy was heating up as we were building out, the internet. And Alan Greenspan was debating. I don't know about should we hike rates aggressively to stop inflation before it really starts? Because there's no signals in the markets that is happening. In the same regard, do you cut rates and kind of put the economy in overdrive? And instead, what he did was he just backed off from aggressively hiking rates and did it very, very slow and gradual. And later, past 1994, the economy started to slow down after a big rip in 1994. And so you had this big move in the economy up in 1994, and he didn't hike rates too aggressively, very, very slowly. And then he backed off and allowed the economy to kind of slow down in 1995, but not have a recession. And as a result, you got a soft landing, and you didn't have any inflation issues, and the economy was able to expand and then have kind of a pause, a breather, with no inflationary pressures at all. And the markets, stocks just kind of, they kept going and going and going. And by the time all that played out, he got nicknamed the Maestro, because everything that went on during 1994, 1995, and into 1996 was kind of like perfect. And his argument was that he kind of stayed back and kind of took his cues from the markets and didn't middle and get involved. And he was nicknamed the Maestro. And to this day, he may have been the greatest Fed chair ever. A lot of people like Paul Volcker as well, because he stopped the runaway inflation from the 70s. But those two, Paul Volcker and Alan Greenspan, were, fantastic Fed chairs, especially when you compare them to what we've had over the past 20 years with Bernanke, Janet Yellen, and Jay Powell. Now, a perfect example of a mistake that happened, I think, is that after the pandemic that started in 2020 and kind of went into 2021, by mid-year 2021, I would say even by the end of 2020, it was very, very clear that inflation was an issue. But because of old, delayed, lagging data, and their hesitancy to kind of accept what markets were telling them, I think, in my opinion, they delayed hiking rates at the end of 2020 and into 2021, and it cost them dearly. And I think it really hindered on the credibility of the Federal Reserve. And it's a mistake that lingers over the Federal Reserve as an institution to this day. I mean, basically in the past 6 years, everything is twice as much as it was, 6 years ago, essentially. And they can't get, uh, rate, they can't get inflation back to their target rate, which they have said is at 2%. So all this, lingers on the Fed. And Kevin Warsh is a guy that wants to go back to a Fed that is, standoffish. And for the most part, I've heard, people that are, entrepreneurs, traders, free thinkers, they love it. They love it. But there's a lot of I would say institution type of economist out there that I would say don't like this. And it makes sense why, because it makes sense why they don't like this is because having someone like Kevin Warsh as the Fed chair will completely change the entire dynamic of how markets function. And this part is what's kind of really complicated to explain. So this is complicated to explain, but I think it's essential to understanding what's going on going forward. Because I haven't heard a lot of people talk about this and discuss this. So basically, when you, for the past, 20 years, give or take, the reactionary function between what the markets say and what the Federal Reserve does has been kind of murky because of the fact that the Federal Reserve is constantly giving this forward guidance and having the dot plot. So the market is, something happens in the world, okay? And the market reacts to that thing, whatever that thing is. And when they're reacting to that, it's basically the market saying, oh, okay, something happened. How is this going to affect what the Federal Reserve does to this thing that just happened? So how are they going to change their summary of economic projections? How are they going to change their forecast? How are they going to change their dot plot based on what just happened? And that murkiness of the market taking something that happens in the world and saying, oh, well, how is the Fed going to, what is the Fed going to do based on what just happened, and when are they going to do it? Based on what, so the market moves based on what they think the Fed is going to do and when they're going to do it, instead of something happening, whatever that thing is. And then the market saying, oh, what should the Fed do? What signal should we give the Fed for them to do something? So that change, I think, is going to be taking place now. It's already started since the first press conference of Kevin Warsh. And this is a change that creates a lot of uncertainty for market participants. especially if you've been around for, you know, the past 20 years, give or take. You're not used to it. That includes me. I haven't traded, I never traded really in the Greenspan era. I started trading in 2005. I was, 19 years old. And I remember, like, right after I started trading real money, a couple months later, he left. And that's when Ben Bernanke started. But the reactionary function here is completely changed. And to make it more complicated, you have a market that was trying to price in what the Fed officials would do and when they would do it and how their forecast would change. Now, but before, when the market was trying to price in what the Fed would do, not necessarily what they should do, get it? The market's also saying, well, we know what these people think. They have history of their speeches, they have history of, how they think and how they want things to be, and how they voted in the past, blah, 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 blah. So the market could predict, do a good job of predicting what they would do, not what they should do. Here's the thing. Going forward with the new Warsh Fed, he's going to be looking at the market for signals. So now it's something happens in the world, and the market needs to price in what the Fed should do. But there's another level to this that makes it more complicated. If something happens in the world and the market prices something in, will Kevin Warsh Fed listen? We don't know whether they're actually going to listen or not. And that, I think, is why a lot of traditional old school economists are freaking out. And they say, oh, it's going to be a much volatile market because the market will be going back and forth trying to determine what should happen and what actually will happen and all. Maybe. That could definitely happen. But you also have to think like this is going to make things a lot more complicated, but also a lot more fun. And it can also give the retail investor an edge to a certain extent because these macroeconomists are very stoogey. They don't think outside the box. If you as a retail investor, an individual investor, can kind of think things through, you can probably maybe find opportunities that didn't exist before. Going back to my previous videos, I've said, I'm going to say it again, at this point, right now, it looks like they're going to raise rates, later this year or early next year. And, we may be in also a period of extended period of time going forward where we don't raise interest rates or anything. We just stay where we are. But cuts are off the table, and eventually, sometime down the road, we'll hike rates. Especially when, Kevin Warsh says, price stability is our main North Star. Well, yeah, that's true. But if prices are stable, inflation comes down, and the world changes in an unexpected way for the better, can you possibly cut rates? Especially if, like right now, the data that comes in for May and June is peak inflation. You start to get some deflationary pressure pressures from the world of AI, inflation gets closer and closer to the 2% mark. Could we cut rates? Is that possible? Heck yeah. I say heck yeah, it could happen. I'm not saying it will happen, but I am saying if things kind of play out in a certain way, war ends, inflation comes down, if we're at peak inflation now, and the target inflation rate gets closer and closer to 2%, especially if it gets a two-handle on it, could a more Fed say, we may cut here? Absolutely. And if you make bets on that trade, you have a really big risk reward. You can make a lot and risk a little because the markets at this point are pricing in rate hikes. So my point is recognizing all these dynamics and thinking them through are going to be a lot more complicated and a lot more challenging going forward. But it creates a lot of opportunity, especially if you can kind of think outside of the box in a way that a lot of Wall Street professionals can't necessarily do because they've been trained to think about what the Fed will do, not necessarily what the Fed should do. So that's where my kind of crazy prediction, at this point at least, is pretty off the wall, that the next rate move by the Fed, whenever that is, will actually be a rate cut. I know it sounds crazy, but it's what I think. And I could be wrong, but it's the bet that has the best reward versus risk available. Because if that does happen, you're going to get a huge move in bonds. You're going to get a huge move in like stocks, like small cap stocks. You'll get a huge move in tech stocks, especially now because they're starting to borrow money to finance their AI build out. You get a big down move in gold. You're going to get lots of big moves and stuff that you can make a lot of money. And this is a perfect example of, because of all this new dynamics that are taking place with the new Fed, it's going to create lots of opportunity if you can kind of read through everything. With all that said, I think it's a fascinating and interesting development, and the way everybody's talking about Kevin Warsh as the new Fed chair really proves my point that this is a huge deal. This is like entering a new world. It's a regime change, at least for the world that we live in with markets and trading and investing and so forth. So, with all that said, let's go to the chart. So there was the other thing that I wanted to do was look at some key stock charts. This is it's an off day. The markets are closed. What else am I gonna do? So let's start out with Meta. I'll just go from there. Basically, I'm just gonna go through my main watch list and all the stocks on the main watch list. Just say if I like the chart, don't like the chart, that kind of thing. With Meta, not much here. It's been kind of trending down. Not interested. Not interested at all. I'd be more interested if it sold off to that lower Bollinger Band and bounced off of it. Then I would be become more interested. I don't like how it got to the 20-day and then wasn't able to bust through it. So with Meta, I'm just not interested at this point, even with the divergence in the oscillator. Pull up a different chart here. Yeah, I'm not interested even with you have a bidivergence kind of that's formed with the oscillators here, but I still want the stock to go down to the lower Bollinger Band and bounce off of it. The way it failed to bounce off of the lower Bollinger Band and then hit the 20-day and then came back down, not interested in it. I'm not super bearish in the stock. I don't think it should go lower, but I'm just not interested in buying it right here either. Let's take a look at the next stock, Apple. Now, Apple looks very interesting. This is a fascinating stock chart. You have a big move up, keeps going higher and higher and higher, above the 20-day, as it then has a pullback, goes right through the 20-day moving average like butter, bounces off the Bollinger Band, and is now coming up to the 20-day. It's a fantastic chart. I think it has a buy point right at around 302. That's a point where I would look to buy this chart, buy this stock with this chart. You have a crossover, nice clean, down move in the oscillator, and a bounce up, having a clean crossover buy signal, and the way that it's sold off and the slow line has come down into the negative territory, it's poised to make a turn up and start going higher down the road. So this stock, if this stock trades up to 302 or so, I think it's a buy. Amazon, just like Meta, I own this stock for the long term, but it's in a downtrend, and the way that this lower Bollinger Band is expanding lower makes me think that it needs to continue to go down and test this lower Bollinger Band until it kind of forms some type of bidivergence on the oscillator, and then you can to buy it. But for now, I think that it's still in bear territory for the foreseeable future. But at a certain point, it will get to a point where it can bounce around and form some type of base, and then the oscillators can form some type of divergence, and then you can look to buy it. And the 20-day will come down and flatten out, and you can get some type of W pattern in Amazon, and it moves up, and you can have a buy signal there. And that could happen in like mid to late July or so forth. But right now, not interested. NVIDIA, the stock that everybody loves, or so it seems. I love the way it's bounced off of this lower Bollinger Band, and now it's just below the 20-day, right at this 211 level. I think NVIDIA is right at a buy point right here, right at 211, and this is a kind of a very key level. It's a kind of a happy place where the stock often goes to. It finds itself going to 211 very often over the past couple months. You see it was here, it's come to 11 once, twice, 3, 4, 5 times at least over the past couple months. So it's kind of a gravity point. It's where the 20 days right now, and I think this is a buy point, especially since it's come off of the lower Bollinger Band and we're ready to make a move through this key 211 point, and can possibly make a surge up towards testing the upper Bollinger Band and perhaps going above 230 and testing the swing high here of 232. So we'll see how this plays out, but NVIDIA is definitely a stock to keep on your watch list, to say the least. You got a nice crossover buy signal here, and what I love also is the slow line has come down from its peak here into negative territory, and now it's completed this down cycle and is now turning up. That's what I love. And if you look at the weekly chart here, you have this big down move in the fast line, and it's ready to pop back up and make another move up after going into the negative. So NVIDIA looks very, very bullish right here. I love it. Right here, 211 to buy. Microsoft, yeah, no good. You have a move up from the base, it spikes up, basically reverses down, slicing right through these lows here, these swing lows made here, and continues to go down. I don't like it when a stock like continues to go down and pushes against the lower Bollinger Band. And as it does that, both the upper Bollinger Band and the lower Bollinger Band, both of them expand. When it pushes that lower Bollinger Band down and both of the Bollinger Bands expand, that shows that it's getting sold and volatility is going up. And as it's going down, I think it's most likely at this point to try to test this low here at 356. As you can see on the weekly chart, the low here on this lower Bollinger Band is 358, which is right next to where this lower Bollinger Band is 358, right close to where this this low is here, right at 357, 358. So I think that's where the stock can go, is 358. Yeah, that makes a lot of sense. It tests this low, it tests this lower Bollinger Band on the weekly, then you get it, the fast line on the weekly to come down here towards where its previous low was, and then it can look to turn up. So at this point, I'm not bullish on Microsoft. Next chart on the docket, Tesla. I think it's just a wait and see. Just a wait. There's nothing really there. Does it go up? It's either gonna. Does it go up to the 20-day, or does it go down to the lower Bollinger Band and retest this low here at 380? And I don't really know. The oscillator is right in the middle. It could either go back up or go back down. There's no real clear indicator here for Tesla. Let's take a look at Google. Google's chart looks really nice. It's very similar to NVIDIA and Apple, bouncing off the lower Bollinger Band. You get a buy crossover. Now the fast line's in the positive territory and it's right below the 20-day. So you have a set up for a move up to test this upper Bollinger Band at least at 395, and I think possibly the 404 level, where this bar was. I have this bar right here, May 13th, right at 404. So that looks interesting to me. I like Google here. And Netflix continues. You have a gap down, and you have this trend down, and just continues to stay strong and just keep going lower and lower and lower. And this chart doesn't have an expanding Bollinger Band on the upside, but the Bollinger Band is expanding on the downside, and this downtrend seems very intact to me. What is interesting is you have some type of divergence forming on the oscillator, so that is a good sign if you're bullish with Netflix. But you got to see, when you come down here, you're like, okay, it makes sense that it continues to go down, test this low here, and then it bounce off as these divergences are formed. But it may have to complete this cycle down, this trend down, and test this low before someone comes in, an institutional investor or something like that, and actually said, okay, let's buy some Netflix. I hardly ever watch Netflix for the most part, but I pay for it. So I think it's not going anywhere. It's kind of the default streaming platform for everybody. I don't know if it will continue to be the case, but it is for the foreseeable future, I think, right now. But from a chart standpoint, it would make sense to to push against this lower Bollinger Band, test the low right here at 75. If you want to be bold, put in an order. You want to buy this stock, put in an order right around 75.50, just below this low. Put an order for it, like 75.50 or whatever, maybe 76, and then put your stop like a couple cents below this low, like at 74. You're risking like $2 or something like that. You risk like $2 for like 10, 20, 30, 40 points to the upside. It would have to be a trade that you can hold for a while, but you have a very definitive risk type of reward thing where you can make 20, 30 bucks, or maybe 40 bucks to the upside. And if it breaks this low and keeps going down, a day or two after that, you're out. Maybe have to stop at like 74, 73. What happens sometimes is the stock will hit that low and kind of go below it, stop out a bunch of people, and then reverse. That could happen. So, maybe buy it at 75 and put a time stop on it. So if the stock goes below the low of February and doesn't bounce back, a day or two after that, then you sell it and get stopped out. That's an idea. And your basis of this trade is that there's a nice divergence forming, both in the fast line and in the slow line. You see how the slow line made a low here in May, the fast line made a low here in April, and you have this higher lows as the stock continues to make lower lows. So it's a shot. That's how you make money in the markets, is doing crazy stuff like that. The stock going lower and lower, pushing its low as the lower Bollinger Band expands, and going in there and taking a shot and seeing what happens. But the one thing about this trade is, I think you're going to have to hold it for a while, because if it tests this low at 75 and bounces off of it, it's going to be a while before it gets back above 85 or 95 or 105. It could take 2, 3, 4, 5 months, but the risk reward is there. Let's go on. Broadcom, fantastic setup. I love how it's bounced off of this lower Bollinger Band. It has a gap up and is right below the 20-day. I love when stocks bounce off of this lower Bollinger Band and then trade up right below the 20-day. That's a great buy signal, especially when you get this upturn in the oscillator. You get this crossover. I would like this slow line to start to be turning up already, but it's not. But that's still okay, because it shows that the stock has completed its bear cycle all the way down into negative territory, and now it's ready to turn up as long as the stock keeps going up. It's shown the way it's bounced off of this lower Bollinger Band, the way it's just below the 20-day. It's at a buy point, and this corrective cycle that's been going on for the past couple months is finishing up. Let's take a look at Astera Networks. That's above the 20-day. It's already made its breakout. This is an example of a stock that tested the lower Bollinger Band and traded back up, and the slow line has turned up, and you have higher lows in the fast line. It's already made its move up. It's already made its initial move up, and it's ready. The next buy point is when it tests these previous highs, and then you can look to buy it now. But this is when the momentum investors come in. The guys and gals that bought early they're already in it, and so you missed that early entry with this stock. This is now a stock where the momentum investors come in. It doesn't mean you can't buy it here. It's just that you've missed the initial move up in this trade setup. Let's take a look at CoreWeave. It's kind of going sideways, back and forth over the past couple months. I don't hate it, but I don't really love it either. You know, this back and forth basing action, it's kind of like a bull flag type of pattern. You really kind of want this stock to move up and kind of break out before you buy it. It is a breakout candidate with this chart, and I still think, you know, you can buy this breakout above these levels, because it's not breaking out to new highs. It's breaking out above this zone that it's been in. So I would just keep an eye on it at this point. Palantir, it's the death of me right now. The stock that's pissing me off the most, because I own shares and I have a huge gain on it, but this stock is just acting like crap. It's just acting horribly, and it's like it can't catch a bid. It tried to catch a bid here, and you know, this is a classic false breakout. You know, trade above these previous highs. You test this high here in late March, and you reverse, and you come right back down to these, you know, key levels that were previous lows in Palantir. And it's just not, it's not getting a good bounce off of these key levels, and it's just very frustrating. You know, and it's still not at its lower Bollinger Band, so it's not setting up where you can get a bounce off of the lower Bollinger Band kind of thing. It can easily keep going, break these lows here, and test the lower Bollinger Band again at 119 or 120. So it really doesn't set up well. And in the back of my mind, I'm thinking, you know, it is a software company. You had the SaaS apocalypse, and it kind of survived that. But, you know, in my own personal life, what I'm doing with, you know, using large language models, it's pretty crazy stuff. And you're like, is it really possible that all these software companies just could go out of business because of what, you know, businesses and individuals can do in the future with software? And maybe, just maybe, the market's recognizing that in its infinite wisdom, that someone like Kevin Warsh, you know, respects as a Fed chair. And maybe, just maybe, the market recognizing that AI is, you know, developing faster, it no longer wants to pay 150 times earnings with the situation that's going on in the world. Okay, yes, Palantir is fantastic software, but now the way technology is developing, the market doesn't want to pay 150 times earnings. Maybe only 100 times earnings. So that's something that I'm thinking about. The world's changing. Maybe software, even if it's high-tech AI software, is not something that has the same moat that it did 12 months ago. So at this point, I'm going to continue to stay long Palantir, but it definitely is a name that I may have to cut. Honestly, you know, for me, the way I trade is that when I sell a stock, I do a swap, basically, and put that money into a new name. I don't have a clear-cut name that I want to buy to replace Palantir. That is the main reason why, from a strategic standpoint, managing my money, that is a clear-cut reason why I haven't swapped it at this point. Now that may change, but right now, thinking out loud, I don't have a clear-cut name that I'm going to move that money into. One possibility is, like an industrial type of stock. I'm not super exposed to AI, like Caterpillar. I could move in money into like ETF, but the thing is that I want to buy the Qs or the SPY or a little bit of both, but I kind of want to pull back. I want to sell off to do that. I don't want to do it right now. I'd rather have the cash on the sidelines and be buying calls with stocks that are running up with that money. So that's what I am doing right now. And the perfect example of that is like Marvell. I own the calls, and I keep rolling up the calls. I keep the calls in the money, but like when they go to like a 70 or 75 delta, then I'll roll it up to like a 50, 55 delta. So I'm locking in my profits, but staying along the stock without committing my cash to owning the stock. Because if a big sell-off comes in, I'm going to have to cut the losses in the calls, and then I'll look to buy stock. And if that happened, then I'd be more inclined to buy shares like a Caterpillar, a Marvell, maybe Bloom Energy, and specifically also the S&P or the NASDAQ, the QQQ, the SPY. But right now it's kind of tricky, I think it's a decent thing right now with this market, the way everything is so extended, to have some extra cash on the sidelines, ready to deploy when you get a sell-off. So I'm not bearish, but have some extra dry powder in this type of market. Robinhood. This stock was driving me crazy for a while, but now it's acting really, really well. You get a nice move here in both the fast line and the slow line. They're just moving up, and the fast line, the slow line, and the weekly chart are moving up. I love this, and the stock is broken out of these previous highs and is just continuing to blast up higher. And I still think you can buy it here because it's so well off its highs. So it broke through this key level here, right around 93 to 94, and it's continued to go up as the Bollinger Bands expand to the upside. The fast line made a new high, kind of testing this previous high here, right on, it's right below it. It's very close, it's just below it, but it got above this previous high, and the slow line has broken out above this previous high here, right at it, and it's back into the positive territory, and this whole selling that took place towards the end of 2025 and this year as well in 2026, the way the slow line has come down into the negative and is now turned to more positive, it shows that selling cycle is over. And it's confirmed here on the weekly chart as the slow line has come down into the negative and now is turned up. So it's still got a long ways to go. It can go up all the way into the positive and then get closer to the highs where it was before. So this all shows that there's a lot of runway to the upside that Robinhood can have. Let's take a look at Micron. Super extended to the upside, and you're starting to see divergences forming in oscillators. The fast line on the weekly chart is super extended and needs to come down. The slow line is, super high and needs to come down. And you're getting highs in the stock as the slow line and the fast line are not making new highs. They were before, now they're not. It basically shows that you're losing momentum. And the stock can continue to go up, but as time goes on, it's going to be more and more difficult for it to go up before it has some type of sell-off and correction. So, it's time to be careful with a stock like this. And if someone wanted to take profits and just sell the stock and walk away, I totally get it. It's just moved up so much. And I'm not saying I'm bearish. I'm just saying that it needs to take a break. And I'm not going to be naive, even though I'm, bullish on this stock. It's very possible, a stock like Micron could go sideways for the next 6 or 7 months. You could pull a Robinhood, and maybe the money is coming out of Micron and going into Robinhood. Makes a lot of sense. So we'll see. Let's take a look at some other chip stocks like Micron. We'll do it more quickly, but the indicators, the momentum, it's all going to kind of show the same picture that Micron shows. Now, Micron bounced off of the 20-day before, and this turned out to be a buy signal for the short term, and now it's pushing up towards its upper Bollinger Band. But I just think it could easily come back and slice through the 20-day and then do some type of corrective action, whatever, for a period of time. So with that said, let's take a look at some other chip stocks, memory stocks. And these stocks will validate the picture that we see in Micron. Let's start out with Western Digital, above the upper Bollinger Band, parabolic to the upside. The last buy signal was when it went just below the 20-day for a day and bounced off of that. Here you have a high, the slow line, you have a high and a fast line. So, it can keep going. But it's getting so extended to the upside. At a certain point, it needs to pull back. But what do I know? Okay, everything that happened over the past week with Intel and Apple's news announcement that they're going to work together, and on top of that Apple is raising prices for consumers. That just validates the issue that we have in the world right now with chips, silicon, wafers being a bottleneck. It just confirms to the marketplace that this is a serious issue, and it's not going away anytime soon. Now, soon is an arbitrary word, but in the foreseeable future, whether it's 3 months, 6 months, maybe 9 months in the future, this problem is not going away. Which means these companies can keep making lots and lots of money. Let's take a look at AMD. Same thing, but it's not as extended as Micron or Western Digital. Let's take a look at SanDisk. Let's take a look at SanDisk. Bounces off the 20-day and then runs up. But here's a good example where you have a high in this fast line, but you look at the slow line here, and you don't have a new high. And that is very clear, showing that as the stock moves up, the momentum is coming down. So be alert of that. Okay, now at this point, we're getting to the point where these stocks can now, at this point, after these huge moves, they can now start to form some type of topping tape action process. When you had new highs after new highs after new highs in momentum, specifically in the slow line on the daily chart, you couldn't make the argument for these stocks to form some type of topping tape action. Now, especially when you see it in multiple names, yeah, these stocks can keep going up, but now you can start looking for some type of topping process to form. So let's take a look at Seagate. Same thing. Look at this. New highs above the upper Bollinger Band, but look. New highs in the fast line on this one. But the slow line, no new highs. And when it comes to the topping process, specifically on a daily chart for stocks, the slow line is more important, much more important than the fast line. And basically what it shows is that this big move up, that momentum short for the traders, basically. The best way to think about it is the momentum for the traders is at highs, right? Which is fantastic. It's going to push the stock higher probably in the short run. But the longer term guys, they're selling. They're selling. Now, what's fascinating is when you go to the weekly chart, the fast line on the weekly chart is the slow line on the daily chart. So the fast lane on the weekly chart are like the investors, that are involved in buying and selling but holding. And the slow line on the weekly chart are like the institutional guys. They're going to keep holding, and they want to keep holding. So, and they're at highs. So that means that yes, it's due for some type of corrective action, but it's not going to be the ultimate top because of the way the slow line on the weekly chart is at highs. So to put the whole picture together, traders push the stock up in the short run, but it can form some type of topping process that forms a basing action that can last 2 months, 3 months, 6 months, whatever. Some type of time in the future. But then at a certain point, probably when this when this fast line gets to this slow line, much lower, big money investors are going to come and buy the stock. Now, a stock that's been in the news, Intel, making new highs here, breaking out, but this fast line is above the previous peak in the fast line, which is very good. But from a longer term perspective, it's not above this high. But it being above this is very good. And it means that the stock can get some future up moves in the next couple trading sessions. With all that said, the slow line is moving up. That's good. But it's big divergence. So the slow line can keep inching and trending up as the fast line kind of goes up. The stock itself makes new highs above the upper Bollinger Band for the next couple sessions. But it's very, very possible that you see some type of topping action form over the next weeks or next few months in a stock like Intel, as well as the other chip stocks. So I hope that helped everyone put everything into context that yes, you have an extended market, it can continue to go up, especially with this strong momentum in the short run, but we're now getting to a point where on the higher time frame players, they are now taking profits and probably putting money in stocks like Robinhood, for example. Let's take a look at Caterpillar. I mentioned that this is a candidate for a stock that I may want to put some money into if I sell some Palantir. Same thing, this slow line is divergence. It's lower than where it has been in the past, but it did get to negative. That's good. So it kind of peaked here, went down into the negative, and now it's turned back into the positive. So what that kind of means is that you kind of got to give it a little bit of time. If it could form some type of, sideways sell-off action. However, the fact that it went through a basing process here, and the slow line went all the way into negative, and you had a divergence form in the fast lines. I'm in a camp where you got to give it a little bit more time to let these oscillators attempt to test new highs. With all that said, it shows that this breakout to the upside has a lot less momentum than the previous breakout that we had in April. Now, that breakout that we had in April here, this one. You see this little breakout here in April. The slow line was not above the previous peak as well. It took time to get above it, so let's give it a little bit of time to see if this all plays out with Caterpillar. But right now the action is very strong, and I like Caterpillar's way it's moving up and breaking out of this consolidation period that we had over the past few weeks. So let's see if there's anything else that I want to take a look at. Just got a text from a buddy of mine who wants to talk about the market, so I got time, so I'm gonna do that in a little bit. Oh yeah, Vertiv. I love this name. This is a nice move. Now it's above the 20-day, which is a perfect. This would have been a perfect buy point right here a couple of sessions ago, right at the 20-day. It's above it, so you may be a little late, but you have these previous highs here, right around this upper Bollinger Band, right at 343. That could be a good entry point. I love the way you have this corrective action in the stock to the lower Bollinger Band, and you subsequently have the corrective action in the slow line. It now is turning up and going up after came all the way down, was negative. In the same regard, you get this divergence in the fast line and the stock spiking up. So everything is in place for the oscillators to move up, the stock to keep moving up, and move towards the previous highs of 379. So I love Vertiv right here. And I'm bullish on the underlying thesis. I love that too. So let's see if there's anything else. Another stock that I just am really interested in right now is Eli Lilly. The whole thesis with them, with peptides and everything, I love. So it had a nice clean breakout to the upside over the past couple of weeks. It's pulling back to the 20-day. What I want to see right here is plain and simple. It has a pullback to the 20-day, undercuts it, but still right on it. It's got to go back up and test the upper Bollinger Band. I want to see a bounce off of this 20-day clean and precise. See this fast line pop back into the positive towards where the slow line is. Plain and simple. And the next stock we're going to look at is the stock that so many people are talking about, SpaceX. Now, everybody is talking about with SpaceX that you can have a big gamma squeeze to the upside, especially when I mentioned this after they start trading options. You can get these retail investors coming in and buying these calls and pushing up the stock. And I think that can happen, possibly. I think that's very possible for retail investors to push up the stock by buying calls. here's the kicker. I was looking at the options statistics in SpaceX very closely throughout the week once it started trading options. And there just wasn't a lot of bullish options activity in SpaceX. Most of the options activity in SpaceX was bearish. My thesis was that the stock would go up if you got bullish options activity in the stock. That didn't happen. I sold the stock at 199. I'm out of it, and I would consider buying it again. And I'm thinking out loud saying this. If the options action changes, where you're getting a low put to call ratio, high number of calls being bought at the ask, and the stock just keeps making highs. Every single little dip gets bought, in the 5-minute chart type of, on a 5-minute chart. I would look to buy the stock, and I wouldn't mind buying the stock at higher prices. To be honest with you, I want to see it prove itself. But the fact that it got above 200 and dropped back below 200 and is now where it was on, it's equal to where it was on the second day of trading, and there's not a lot of bullish options activity. I got to kind of take a step back and see how this develops. From a fundamental point of view with SpaceX, I think the stock is super, super, super expensive. I mean, it trades at 92 times the revenue with no earnings, and I personally don't want SpaceX to merge with Tesla. I know it's a very high, it's becoming a high probability that it can happen, but I personally just don't want it to happen. Merged company, both SpaceX and Tesla, I'm gonna have to reassess everything. Just makes everything more complicated. But like right now, I don't like Tesla, okay? And I think I can become bullish on SpaceX, especially as the company develops in the future. Specifically, think of the data centers in space. But if they're merging with some car company, that just makes everything more complicated, and I don't know if I want to deal with that. I like that thesis with SpaceX of having data centers in space, and I like that thesis with Tesla of having robots take over the world. But it has all these other projects that I just don't know. I don't feel comfortable about it. There's not a chance in hell, heaven, or earth that I am going to be living somewhere in space or Mars or something. It's not going to happen. I'd rather just die for that than that to happen. Sorry, but that's just how I am. With all that said, I am going to sign off. Thank you very much, everyone. I hope you enjoyed this video, and I hope it taught you something and you learned. And with all that, take care, everyone. Bye-bye.